Hi, everybody. My name is Simon Singer. I'm the founder of the Center for Tax Strategies and Resources, and I am very honored to have as our guest today Bruce Givner. And when he finishes our 45 minutes or an hour, you will be very pleased that you took the time to listen to him as well. Bruce is one of the preeminent tax attorneys in the country. I'm lucky enough to have had a business and a personal relationship with him for over 30 years now. And he taught me an incredible amount about tax law and about working with CPAs, has given me some referrals to a lot of CPAs that we wound up doing a lot of business with together. And I thought it might be interesting if you got a chance to listen to $1,000 an hour person talk to us, not only about the tax law, but about the process in getting more quality referrals, how to work with CPAs, how to work with tax attorneys, what they're looking for, why they really shouldn't be so intimidating to us, but they tend to be. So Bruce, you're what? You're 69 years old. You're almost 70, and that. Oh, wait a second. That makes me older. Ah, yes. Yes. So Bruce, when did you become a tax attorney? How long ago was it?
June of 1977. I first started working for Howard Sanger, my boss.
And I've heard you tell me many times that Howard was a very substantial mentor to you as well.
Still is. I was emailing back and forth with him yesterday.
He's in the desert, is he not?
Palm Springs, yes.
Yep. So let's kind of start with some things. If you were to describe to somebody what your practice looks like, which is saving people all kind of taxes, what kind of taxes would that be?
So I say that we can reduce or substantially reduce and potentially, rarely, eliminate estate taxes. We can reduce, defer, or eliminate capital gains taxes. We can reduce or eliminate the tax on passive income. And we can reduce, the most difficult one of all is reduce the tax on earned income. So they're in that order of difficulty. It's easiest to substantially reduce estate taxes. It's the next easiest, but more difficult to reduce, defer, or eliminate the tax on capital gains. It is very difficult to reduce or eliminate the tax on passive income, and it is impossible to eliminate the tax on earned income, but you certainly have come up with very interesting ways to reduce the tax on earned income, and we use those.
Well, but if I recall correctly, what I did was I took a couple of things that you taught me and put them together and came up with kind of an interesting result, which didn't eliminate, it deferred, it reduced. That's for sure. But that was with a professional. It wasn't with an employee of a firm. Correct?
Yes.
Yeah.
But when you say you just did this, I am reading a very interesting book now called The Second Machine Age, which is from 2013. So I wish it was updated because it's a wonderful book. But they talk about how truly important advances are recombinant technology, which is someone just doesn't invent something. It's not like Madame Curie, inventing something, or, Dr. Salk coming up with a new vaccine. It's taking this thing over here and that thing over there and that thing over there and putting them together. In other words, Bill Gates didn't create personal computers, but he put things together in a very attractive and effective fashion. So yes, you combine several things, but that's, created something very, effective and something that didn't exist before.
Well, it's interesting, and I remember we had talked about a private retirement trust, which is a California only, that I know of at least, opportunity. And then you were at our meeting that we had in January of, I think it was 2019, where you talked about the C corporation tax dropping down to 21%. And I'm thinking to myself that maybe we can put those kind of things together and come up with a whole that's greater than the sum of its parts. And we talk all the time, and I know you've heard me say this a million times, timing, combining, and sequencing, which is, I think, what you just referenced.
That's your statement.
Yeah. Actually, it was probably somebody else's statement, but in our industry, if you say it 3 or 4 times, it becomes yours. So tell me, what does your perfect client look like? Who would you like your next? Well, I don't want to go that far but what does your perfect client look like? What kind of age? What kind of assets? And then we're going to go to the average.
So right now, the biggest part of our practice is reducing, deferring, or eliminating capital gains. And by the way, there's a lot of life insurance sold in reducing, deferring, and eliminating capital gains, as you know.
Yep.
And so there's two types of capital gain clients, and it's not age-based typically. The two types are where the asset value is like this, meaning it's stable or slightly increasing over time. We try to teach the referral sources to listen to the client who's saying, I'm thinking of selling in 2, 3, 4 years. We try to teach the referral source to say to that client, stop, let's go see Givner today. Because if you can get them in 2 years or more in advance of a sale, we have many more and more attractive structures to help reduce, defer, eliminate the capital gains tax. And of course, most people don't get to us that far in advance. If you can get them a year before, that's still very attractive. But as you can imagine, most people come to us and they've already signed a letter of intent or they've already opened escrow, and it's often too late to do any good planning before the sale. We can only talk to them about after the fact planning, which is not as attractive. The other profile is someone who's got an asset with a value that's skyrocketing. And if we can get to them the year before, in other words, the guy comes to us and says, I've got 1 million shares at a penny. That's how much I paid for them. They're now worth $1, but next year it's going to be worth $30 a share. That's a very attractive fact situation if we can get them a year before. So in terms of ideal for capital gains tax planning, the real key element is timing, far enough in advance so we can actually do a good plan. The other 3 criteria, how we pick among the, let's say, 15 different ways to reduce, defer, eliminate capital gains taxes is nature of the asset, size of the transaction, and speed of the increase in the value of the asset. So capital gains, there's no age. Now, when it's estate tax planning, well, the age does enter into it because you can have a 40-year-old worth 150 million, and that 40-year-old has no interest whatsoever in doing estate tax planning because he's going to live forever. And if he does estate tax planning, it's because we tricked him into it by doing asset protection planning,
Right.
and it's really estate tax planning. And people think, $10 million isn't a lot of money for estate tax planning, and it's not. But if you have a 90-year-old who's worth $10 million and she's already completely used up her exclusion, which is why her children are worth 20, well, $10 million for a 90-year-old with no exclusion, that's a big estate. So, there is some.
Yeah, because she's going to have to pay, or the family's going to have to wind up paying $40 million in estate tax, even with today's rates and today's exemptions.
So you said 40, but I think you meant 4. But yes, that's correct.
Well, I'm what business I'm in, so we tend to exaggerate.
So in estate tax planning, the average client who comes in the door is in their 70s, and they're worth, the average would be $30 to $80 million. And it's interesting that you actually make more money from people in the $30 to $80 million range in estate tax planning than you do with someone worth 200 to 500 million or $1 billion. And the reason for that is someone worth 800 million or 600 million or 400 million, they say, whatever my children get, it's going to be a lot of money anyhow. Well, a lot of them just aren't terribly motivated. Whereas you get the person in who's worth, $50 million or $60 million, they're 70 years old, they're going to live another 15 years, and $50 million is going to be 75 million, and the exclusion, which today is 23 million maybe then is only going to be worth, 13 million, the exclusion. Well, now you got 75 minus, let's say 15. So that's 75 minus 15 is what, 60? So 60 times 40%. And now they're afraid the estate tax rate's going to go up. they're more motivated than the person worth 200 or 300 or 400 million. So the
Sure.
sweet spot often is much less than you would think.
But I've been in the room with you many times when people have said, what do I care if my kids get 20 million or 40 million? 20 million is a lot of money. Nobody ever left me 20 million. I'm afraid if I leave them too much money, I'm going to ruin them, et cetera, et cetera. And I've heard the explanation of, we're not talking about making rich kids richer. We're talking about whether or not you'd like to have some control over that extra $20 million that by default is going to go to the federal government unless you completely approve of what they're doing. You can have control over what happens with that money. And once in a while, I've seen you be able to turn people around with that change in their thought process. Isn't that right?
Well, I would say that you are the interpreter, so you are a better person at that than I am. I mean, truly, I come into the room as the technician, and I rely on the other person to be the one who's converted them to want to do the planning. I know I've frustrated some referral sources where they say, what can you do to get the client to do the planning? And I said to them, it's not my job to force them to do the planning. I can help them do the plan. If they want to make the estate tax go to zero, or they want to dramatically reduce the estate tax, I can do that. But it's not my job really to talk them into it. So if you're the money manager, insurance agent, estate planning lawyer, pick another profession, I'm relying on you to bring them to that. So, part of the reason why our relationship is so good is because you're the one who motivates them to want to do the planning, because you look into motives that I might not be able to, to pull off. I'm a technician, and you're not a technician. You're
I'm a sales guy. Yep. And I'm not saying that as a negative, but there is power in having two people in the room.
Yep.
There is power in one person making the quote sales presentation and the other person verifying if in fact is legal, moral and ethical. Because there's always going to be a little sidebar meeting after the salesman leaves the room, and that sidebar is going to consist of that client turning to his CPA and or the tax attorney and saying, what do you think? And if we've done our education job well enough with the professional advisors, they can in good conscience say, well, based on your facts and circumstances, it makes perfect sense. And we know how to handle all of the legal aspects of that to make it work. Because we just come up with ideas. We don't fully have the ability to be able to implement or don't want to. I want to control who they talk to after the meeting, because if I don't control who they talk to, what's going to happen is they're going to talk to their wife, brother's, hairdresser's uncle, who one time walked by a law officer or an insurance company and deems them to be an expert. I want an expert in the room with me. I want my 400-pound gorilla, which in this case, we're talking about a guy like Bruce Givner, and you should also. So let me continue. Where do you get your majority of your business from? Who sends you the client?
Well, probably 70% comes from CPAs. And when the CPA walks the client in the room, the CPA has already taken the client and said, you need to do X. You need to plan to make the capital gain go away. You need to plan to reduce the estate tax. You need to plan to reduce the income on your the tax on your passive income. You need to reduce your earned income. So those are easy situations for me. There's nothing for me to do other than to fulfill the goal that the CPA has already articulated. But the other 30% comes from, much of it is from lawyers, including estate planning lawyers, because they don't know how to make an estate tax go down dramatically. They do wills and trusts. Obviously, insurance agents, money managers, and some lenders. But insurance agents are always the best salespeople. And what I think you and I discussed is that when you present the planning to the client, the problem you have is that the CPA is the deal killer.
Yep.
And what I tried to help you with, which obviously you were superb at, was to come up with ways, especially when I'm not in the room, to beat down the CPA as the deal killer. And when I'm in the room, it's easy because I can beat down the CPA as the deal killer, but you have meetings when I'm not there. And when you have meetings and I'm not there, how do you beat down the CPA as the deal killer? And I think we initially hit upon being able to spout code sections, and,
Yes.
and secondarily to code sections, certainly be able to speak with authority about a grantor trust versus a complex trust. And the fact that you're able to do that, it puts the CPA goes like this, that, puts them on edge. So if you can say, gee, it's a grantor trust which is disregarded for income tax purposes, and they go, because 90% of all CPAs have no idea that an irrevocable trust can be disregarded for income tax purposes. And so just simple, and if you can say, under the IRS is likely to assert 2036 as a way to include that transfer in the estate of the decedent, you go, CPA is going to go, what? And that's clearly the right code section. So the ability to spout a few code sections and to talk about the word own and say that the word own has a completely different meaning in the income tax laws than in the estate tax laws, which 90+% of all CPAs don't know, that's the way to put them on edge, that they're not dealing with some airhead who's just, I remember one of my favorite business cards from an insurance agent, his business card said, insurance peddler. And that's because that's what the CPAs, especially if they don't know you. If you walk in with a big, I remember when Bob Shader was still alive, I mean, he's been dead for how many years, 5 years or whatever. When Bob Shader walked in the room, he was Bob Shader, and the CPAs didn't blow him off, right? But most insurance agents don't walk in the room with the gravitas of Simon Singer or Bob Shader. And, when you walk in the room and you don't have that outsized, reputation, which you've got, which Bob Shader had, right? You're just an insurance peddler to that, you've sold the client and now the client wants you to meet with their CPA, right? Yeah. And you can't bring some Bruce Givner into the room. So now you're meeting with the CPA and the CPA just views you as an insurance peddler. So how do you back that CPA down? And the answer is, if you know a certain, look, you're not going to know the Internal Revenue Code the way I do, and you're not going to know all the concepts, but if you can say, look, I don't do this for, I'm not a tax lawyer, but I've seen a very good tax lawyer use in this situation with an S corporation, a grantor retained annuity trust to make the stock of the S corporation go to zero in 5 or 6 or 7 years. CPA is going to go, well, yeah. Because the CPA's never done a GRAT or been part of a GRAT that made an S corporation go to zero in 5 years. And I'll bet Simon Singer can say that because he's seen it more than once. And well, right?
It's the advantages of a relationship with people that are better than you are at subjects that you want to participate in, but I don't need to be an expert. I just need to know some labels.
Yeah, I mean, if you've seen me take, 50 million of real estate, drop it in a family limited partnership, get a 40% discount, and then use the cash flow to insert a private annuity to make the whole 50 million go to zero, you can say that in 2 minutes and the CPA is going, because the CPA has never seen a private annuity. I mean, so you've already, established that you're not simply an insurance peddler, that you've had experience with very heavyweight, very sophisticated planning. I got an email yesterday from Will, whose last name and I'm not going to say, but Will sent me an email saying, hey, I just got copies of slats that this lawyer drafted for my clients, and I'm concerned because they were signed on the same day. Doesn't that violate the reciprocal trust doctrine? Well, how is that for a sophisticated comment from an insurance agent, right?
Yep, exactly.
So, Will, like Barry, who you and I both know, right, is a technician. He tries to pick up as much technical stuff as he can so CPAs and other deal killers can't just blow him out. And he uses, he and Barry both use that with lawyers too, because often the estate planning lawyer is in the room and the estate planning lawyer is a deal killer, right? And they're completely unsophisticated because all they do is wills and trusts.
Once in a while, a little bit of gifting, but that's about it.
Yep. Or they've done an insurance trust. That's the extent of it, right?
Yeah, no, we're both speaking out of the same sides of our mouth. We understand what the issues are, but there are ways to maneuver around the issue, and one of them is to ask a lot of questions, because then you don't back yourself into a corner. And if somebody thinks that a pension plan or a life insurance causes cancer in laboratory animals, if you made it as a statement, it's hard to get out, because then you kind of look like the guy on the beach who's got wristwatch on one arm and fountain pens in an inside pocket, and he'll sell you anything you want. But if you ask it as a question, you can move on to another question. You
Well,
might say to them,
there's
yeah,
another part of your strategy, though, which we shouldn't omit. The other part of your strategy was, and I helped push you in this direction, but still it's your strategy, which is how do they make money? Follow the dollar. And when we can convince the CPA that all this complexity is going to generate another $10,000 a year of billings, if we can do that subtly, then the CPA says, oh, there's something money to be made for me here. And when I get involved and there's an estate planning lawyer in the room, I say to the estate planning lawyer, how much of this would you like to do? Would you like to create the irrevocable trust for the children? Would you like to create the family limited partnership? Would you like to draft the private annuity? If you want, you can draft all of them and I'll just review them if you wish. If you don't, I'll leave and you can do everything. And the lawyers often go, no, I don't want to do that. And I say, by all means, go ahead and do it. And this should be the first time and I'll review it. And so we try to make nice to all of those professionals. We're not necessarily trying to, scare them off or shut them down. We want to make them part of the team. That's part of your philosophy, right? Make them money, make them team players.
absolutely. And you remember my case in Youngstown, Ohio, that I blew. What is that, 1979 or so, that I blew because I embarrassed the CPA and the attorney by trying to prove that I was the smartest guy in the room. And despite the fact that on the surface, they always complimented how brilliant I was, which I wasn't, but it was okay. But they would never let me win. And that changed my career. I became focused on making them part of these teams and letting them be the smart guys, and just let me get paid. That's all. Because there's lots of ways to skin these cats. You just mentioned a family limited partnership and a GRAT and a sale to a defective trust. And some of those involve insurance and some of them don't. And all of them can involve investments of one type or another. But when you put those things together, all of a sudden you've got, if you got a 5-year GRAT, you've got at least the growth in that asset outside of the estate, and a discounted value of what the original value was came back in, and do it again and do it again. Once people get used to things that sounded too complicated and sounded too intimidating and sounded too difficult, once they get used to that, I've heard you tell people with an FLP, when we talk next year, you will remember that I told you, meaning you, Bruce, that I told you that you won't notice any difference at all, except your taxes would have been reduced. And that's what you have to do. Is they're not necessarily always completely comfortable at the beginning, just like our members aren't necessarily comfortable in picking up the phone and proactively calling an attorney or a CPA. Those people need revenue also. Those people are wondering, with rare exception, where their next case is coming from. Well, we're the key to that pot of gold for them, because we have the clients, we have the prospects. We can become adjunct business development departments for the professional advisors in the community. And Bruce said that about 70% of his new business comes from CPAs. Well, that might be a bit of a clue. And I think I mentioned that we're getting ready to roll out a CPA Alliance program. Bruce, I'm remembering your bottom feeder conversation on Ventura Boulevard, where there's might be 50 CPAs, and every single one of them has at least one client that you would like to do business with. They may not have 10, they may not have 50, but every single one of them have at least one that you're going to want to do some work with. But you got to have your team in place. You've got to have your labels in place. You've got to be patient, because if they smell desperation, or all this guy's trying to do is sell my client something and And why should I agree to that? Because I could be held accountable. I don't want to do that. But helping them understand that you can help them generate revenue, that's what they're in business for also. And any of them that tell you, I've gone to some of these leads breakfasts and saw sitting there a CPA who told me a couple of weeks earlier that he doesn't need more business, and that there he is sitting at a leads breakfast. So it's just a very, very. Let me get back to you, Bruce. Let's see. Besides our organization, do you do any teaching for other producer groups? I know you do it for CPAs. You do that all the time. Do you do it for any other producer groups?
No, I do not.
And the reason would be what?
Well, I mean, I have in the past, and I guess I would if I'm asked, but I've got to be careful that I don't bite off more than I can chew, right? So, you've got to balance your marketing with your production. So I've got to be very careful that if I'm out there, a quickie story. There's a CPA who's not a CPA, I apologize, an appraiser, a business appraiser out there who's made herself the queen of a certain area of business. And I referred her a matter. And she's out there constantly marketing her expertise in this area of business. And I referred her a matter. And it took her 9 months to get the appraisal done. Well, I'm never going to do business with her again.
Right.
I sent her an email 6 months into it. I said, say her name is Sally. I said, Sally, help me understand. You have this constant drip of emails about how you're an expert in this area. Let's say it was spaceships. Okay. It's definitely a new area of commerce. And we know there's one very big area of new commerce that's going on in California and many other states right now, raising a lot of revenue for the states. And I said, you're always marketing this. Why would you always be marketing this if you can't get the work done that you've now got in your office? So that's the end of my comment. I'm trying to be very careful that I don't stick my nose out too much and not get the work out the door. So it has to be a constant balance.
Yeah, which is one of the reasons, because now that makes perfect sense. That's one of the reasons why you've asked us to filter our members and their situations before they pick up and call you, so that we can judge whether or not this is something that's potentially worth your time. As otherwise, you'd be in that biting off more than you can chew scenario with people who don't have relationships and or control with their prospect or their client, and B, don't know how to set the stage correctly. Because I mean, do you remember we used to work off of scripts as to how the CPA should introduce and how I should introduce and how Bruce should introduce, because the client's looking around the room, and if there's 4 people in the room, he's going at the time $500 an hour, $600 an hour, $300 an hour, $1,000 an hour, and he's not paying any attention. So we had to learn how to make proper introductions so that the stage was set correctly. Do you recall that we used to read those off of the laptop computers?
Yes. But at this point, you and I are in more mature practices. And so we try to, when I was trying to build a practice more, you were still sort of in the building phase at that point.
Absolutely. Yep. Absolutely.
But when you have a more mature practice, you got to make sure that, that it's a sweet, fat pitch coming down the center of the strike zone. If it's not, there's a very limited amount of time you can afford to spend. I mean, I say to the referral sources, I'll spend 30 minutes, talking to someone about their goals and objectives and their facts. And then I can show them in that 30 minutes how I can meet their goals and objectives and their facts. And then if they want to go beyond that, it's $2,500 for the first 2 hours. And after that, my time is $1,000 an hour. But in the first 2 hours, I can tell them specifically how we can do what they want to do, whether it's estate tax, capital gains tax, or whatever. And I can quote them budgets and timelines. So, I just try to I want to be very helpful. 30 minutes for free is good. But after that, it's 2 hours and it's $2,500. And if they're trying to save $10 million in capital gains tax, no one has a problem paying $2,500 for the first 2 hours.
So tell me, because you've done a presentation for us on tax shelters that sounded incredibly good, but in fact might be too good to be true. And the Internal Revenue Service has released their Dirty Dozen. Could you review some of those so we may be able to save careers of some of the people on this call?
So the most recent version of the Dirty Dozen, the IRS added the Malta pension plan, abusive use of the Malta pension plan. Obviously already on there were micro captives, which we've used for a decade at least, and the monetized installment sale, which we've been using for a decade at least. But the IRS updates that all the time, and something that you and I said how many years ago, 20 years ago, we said, if you have a good idea, shut up.
Yeah.
And if you don't understand shut up, there's a forward alternative to it, which is shut
the
up.
Yeah.
And people are stupid. In fact, I was talking the other day with a guy, and he dates back far enough to remember Doc Houck of the National Heritage Foundation, and he knew Kenny Hartstein's name.
Okay, yeah.
So, I mean, you know, you go back to 412I and 419AF6, you know, with Koresko and all those. And the idea is, if you have a good idea, shut up. And people come up with these good ideas, and then they go on the internet and market them. And it's a bad idea. It's just a very bad idea. So when I say there's 4 tax shelters, there are 4 tax shelters. The 4 tax shelters are pension plans, charities, charitable remainder trusts, and life insurance. And what makes them tax shelters? Well, there's 3 things that you can do with money. Money goes into a structure, money stays in the structure, and money comes out of a structure. And each of those 4 things have 2 of those 3, okay? Pension plans, the money goes in deductibly, money earns money income tax free, but when it comes out, it's taxable. Charities, money goes in deductible, earns money income tax free, but you can't get anything when it comes out except a small salary. Charitable remainder trust, you get a deduction on the way in, money earns in money income tax free. When it comes out, it's fully taxable. Life insurance, no deduction on the way in, and that's what everybody keeps trying to do, even though the IRS tells you you can't do it, which is you can't get a deduction for cash value life insurance. But it earns money income tax free, and every way money comes out of a life insurance policy, it's tax free. Well, my expertise is getting stuff into a life insurance policy. I can get an apartment building into a life insurance policy. So those are the 4 tax shelters: pensions, charities, charitable remainder trusts, and life insurance policies. But people keep coming up with new stuff all the time, and you just got to be careful.
And micro captive is one of those.
Yep. And the IRS doesn't like it.
Yeah, because if money goes in income tax free and then it never gets taxed again, the Internal Revenue Service just doesn't like that. So there are ways to reduce other taxes and then use the conversation of timing, combining, and sequencing. I saved you $1 over here, which gives you $1 more over there, to be able to put money into an asset that grows tax-free and distributes tax-free. You can get there, you just can't get there directly.
Yep. And you got
it. I mean, you know, we got that strategy with pension plans.
You've come up with things that are good results, and some people say, well, and you say, wait a minute, a good result, perfect, can't be the enemy of good, right? If we reduce the tax from 52% to 38%, and you run enough money through that from 52 to 38, that's a good result, you know. And good is better than 0, and it's not as good as perfect, but good is pretty good. And you've come up with a structure that reduced 52 to 38, and that's a pretty good result.
You know, Vince Lombardi used to say, you can strive for perfection, but you'll never achieve it. But in the striving, you'll end up at great, which is pretty darn good. Pretty darn good indeed. Okay, so what do you think the 2 or 3 most interesting opportunities for clients, our members, and you?
Well, for the members, I think there's still nothing like generational split dollar. Generational split dollar is still available. It is something where the client has no choice but to buy life insurance. What happened is you have 4 cases. Morissette case, April 13th, 2016, the taxpayer won summary judgment. Levine, July 13th, 2016, taxpayer won summary judgment. Cahill, August of 2018, the taxpayer lost summary judgment, settled with the IRS, terrible result. And Morissette 2 just came out less than 2 months ago, 2 months ago. And Morissette 2, although, well, Morissette 2 is 2 parts. I think I can do this very quickly, Stuffy.
That's okay.
So the first part, the court addressed the tax law, and the taxpayer won on 2036, which is your basic inclusion in the estate tax section. The court said, you win, taxpayer. You had predominantly a non-tax motive. Mrs. Morissette's motive was to provide for succession in the closely held business. And the court made 2 very important statements. One was, the fact that you had some estate tax savings motive is okay as long as your predominant motive is a non-tax motive, which in this case was succession of the business. The other one was the fact that your advisors had an estate tax motive is not imputed to you, the taxpayer. Well, that's pretty good because the people selling her this product, this structure, said, hey, look at all the estate taxes you can save. And the court said, I don't care what they said. I only care what you were looking for, Mrs. Morissette. So the taxpayer won under 2036 and 2 other code sections, 2038 and 2702. A very, very important result. By the way, Morissette 2 was a economic benefit regime, and you know, Stuffy, you and I only do the loan regime, which if anything is significantly safer. And the court said that in Cahill, which was a taxpayer loss. The second part of the case, the taxpayer lost horribly. However, we can learn from the taxpayer loss in Morissette. Here's why. The taxpayers in Morissette 2, for the actual discount, had 2 appraisers, and they picked a 15% discount factor. And that's how they came up with the 75% discount for G2, which was in their 60s. The IRS picked 1 appraiser, and the appraiser picked a carrier-specific discount. So for one carrier, the appraiser said 8.5%, and for the other carrier, the appraiser said 6.5%. That's part 1. Part 2 was there was evidence that the brothers were going to terminate the policies as soon as the statute of limitations ran. Well, no matter what the discount factor is, if the term is only 4 years, there's no discount. Yep. So what we do is we want to make sure we pick an appraiser who's going to have a carrier specific discount. But if you have a 6, 7, 8% discount and you have G2, which is the one I'm working on right now, 36 years old, you're going to get about an 80% discount. And now it's not as good as the 92 we would have gotten before for the 36-year-old, but 80% is really good. And that's enough reason if you have a client paying a $10 million premium on which the members are going to make some money, Simon, right?
Oh, yes. Oh, yes.
And you're saving 40% of 8 million, which is 3.2 million on a $10 million premium. The client's going to be very happy with that. So GSD is still a really good thing for the members, okay?
We've been doing them how long now? 20 years?
No, I think the Palos Verdes was longer than 20 years ago, but.
Oh, really?
Yeah, I think it was longer than 20 years ago, but I may be wrong, okay? That had to be 1995.
Well, you're right. We're in the 20s, aren't we? Son of a gun.
Yeah, no, I think that was, I think it was 1995 when you and I were in Palos Verdes Estates.
Yeah, but the thing that you've taught me about a lot of things like that, which is that single purpose planning is not a good idea. Have multiple reasons why somebody wants to do something, which is what you just said happened in the court with Morissette, because the lady is who the intention was for, not the advisors. Yep. And her intention was to keep the family together, to keep the business together, et cetera, et cetera. The fact that it happened to reduce the state tax also, that's multiple reasons for entering into the transaction.
So that's opportunity number 1. The other opportunity is capital gains tax planning. If you have a client who has an asset that's worth 10 million today, and they think it's going to sell for 30, 40, 50 million next year or the year after, that, my friends, is life insurance. So, you know, do you want to stop now and I won't go through that, or do you want me to go through that? What would make you happy, Stuffy?
Well, you know, the answer is you can probably go through anything you want. Just remember that everybody on this call is not a member.
Okay.
So
All right. Well,
I think I'd hold it back until you're going to be speaking with us in Las Vegas, yes?
Okay. Yep.
Perhaps we'll do that at a breakout session. So that'll be for members only. Bobby, have you got, Bruce, as always, this is always fun. It's always educational, even though, because I don't have your kind of memory. But I remember things when I hear them for like the 17th and 18th time. But can I just pull them up like you do? No, I can't. And I never will. And to be honest with you, I don't like trying to do things that I'm not really good at. So I like to create these strategic planning teams because it works, especially when you've got a team owner that's willing to listen. We had a call yesterday, may not go anyplace, but we had a call yesterday with an individual whose only objective was to do a charitable remainder trust. But I know that we had previous conversations with this client. It was worth about 40 million, where he wanted to do a whole bunch of other things. He wanted to reduce capital gains, reduce income tax. We'll get there. We'll get there. We don't have to do everything at once. Bobby, have you got a slide on the upcoming meeting that you can throw up on the screen? And because remember, I can't see your screen. So we've got, I think, 3 tax attorneys that are going to be at our meeting. Bruce is one of them. Walt Dallas is another. Joe Strazzeri is another. They're each going to be talking about different levels of the tax code as to how to improve your relationship with professional advisors and with clients and generate some money at the same time. We've got 2 or 3 major producers, the all-time leading sales leader with Guardian Life, another individual who provides all of the insurance product, which in this case is single premium immediate annuities for charitable gift annuities for one of the largest religions in the country. Let me just think. We've got some marketing people that I'll find that you're intriguing. It's 21 hours of instruction and training and breakfasts and dinners, and it's being done at a private club in Las Vegas, so we don't have to be crowded and concerned about COVID. If there are COVID restrictions, we'll abide by them. But right now, the only restriction Las Vegas has is groups of 250 or more. We're staying at the Westgate Hotel, which is directly across the street, and we'll have shuttles going back and forth as well. I'm not sure what the price is, and as I said, Bobby, I can't see your screen. But if you want more information about that, you can call Brad Etheridge at 616-485-2008, I believe. If anybody's got any questions, you can kind of raise your hands, and hopefully Bobby's going to be able to see it, because I have a screen that doesn't show me much of anything. So I didn't have to look at Givner, and he didn't have to look at me. Bruce, thank you.
I do have a couple of questions here, Simon.
Sure, go ahead, Bobby. Would you read them for me, please?
The first one, Anthony asked about the pricing. No, it's a typo. It's not $9,000 for non-members. It's $700 for members, $900 for non-members. That expires tonight at midnight, and the price will go up. Bruce, got a couple here for you. First one is, are there a few key revenue codes that we should be specifically aware of? If so, can we get some recommendations?
Sure. 2036 is the most important estate tax planning code section. You can read it in 3 minutes, but that far and away, if you're doing estate tax planning, there is no more important code section. That is the code section the IRS uses to batter down any estate tax planning idea. It's what it uses for family limited partnerships and basically anything. So that's really the code section you want to know. In terms of income tax planning, if you can understand, this is subchapter J, which is section 671, through 679. And that's a lot of code sections, so I'm not suggesting you read them all. But if there's one in there, it's section 675, parenthesis 4, parenthesis C. That's the way that you make an irrevocable trust a grantor trust, which is disregarded for income tax purposes. That is the way the grantor reacquires trust corpus by substituting assets of equivalent value. Almost invariably, that is the way an irrevocable trust will be made to be a grantor trust. There's an alternative to that, which is 677A3, which is if the trustee can use trust income to buy, to pay for a premium of insurance on the life of the grantor. So either one of those is a good section to know in terms of making an irrevocable trust disregarded for income tax purposes. So those are probably the top recommendations. I could certainly come up with others, for example, relating to insurance policies. It's helpful to know section 101, which is the section that says insurance proceeds are tax-free, which also has the transfer for value issue in it. There's lots of others, but I think 2036 and the disregarded sections that I mentioned are probably the most important ones.
One of the ones that Bruce, you showed me 25 years ago was the 531 accumulated earnings tax issue with C corporations, which the penalty of 535 was significantly larger at the time than it is today. You don't run into anywhere near as many C corporations as you used to. And the penalties are nowhere near as severe, but suffice to say that the Internal Revenue Service doesn't want you to accumulate too much money in your C corporation. They want you to declare a dividend if you don't take it as compensation. And
part of your structure, Stuffy, is to create a C corporation. That's part of the way you created your structure to divert income from an S corporation over to the C corporation, which then adopts the private retirement trust, and that's how we get an insurance policy in there. And partly to follow up on your comment, which is what's good for our members, I can say that whether it's estate tax, capital gains tax, passive income tax, or earned income tax, there's an insurance sale in every one of them.
Yep. It's kind of like the old joke of I know there's a pony in there someplace. But the reality is you just have to know how to position yourself. You have to know how to position the advisors. You have to know how to communicate with both the client and the advisor of what's in it for them. The solutions at our level are really relatively simple. What's complicated is getting people to say, yes, I like the result of that. How do we go about doing it? Whatever that might be. Bobby, you got any more?
Sorry,
Robert?
Yep. Bruce, could you repeat let me see what this says here. The in, stay out of money taxation, pension, charities, comparisons?
No.
Oh, so the four tax shelters are pensions, charities, charitable remainder trusts, and life insurance. And there's three places for money. One is going in, one is staying in it, and one is coming out. And the first three, pensions, charities, and charitable remainder trusts, there's a deduction going in, and the money earns money income tax free, but any money coming out is taxable. So that's the first three. They're identical in that respect. The last one, life insurance, you don't get a deduction on the way in, but the money earns money income tax free, and all money coming out of a life insurance policy is tax free. So the question with life insurance is, how do you get stuff into a life insurance policy? In other words, I've got a $10 million apartment building that's generating $400,000 a year of taxable income. How do I get that in an insurance policy? And the answer is, I know how to do that. And the client might like that an awful lot. Is that responsive?
Yeah, then they're operating in a tax-free environment for the rest of their family's lives.
And if you do it the right way, it can be estate tax free also, depending on how you get it in there. and there's a commission in there to be made.
Yeah, but that creates a tax problem, and you know that can be tedious having too much income. You know, for the non-members on this call, you know, we've got some really incredible speakers. You'd be doing yourself a favor. It's 3 days. It's the 29th and 30th of September and the 1st of October. We run from 8 in the morning until 5 in the afternoon. Most people we see do not go onto their computers. They do not leave the room because there's always something going on that's incredible. We have a woman, an ex-surgeon, Dr. Vicki Rackner, that's not only going to be talking about how to interface and work with doctors, how they think, how they process information, how they make decisions, but we also are having her this time talking about how to work with seniors. She's done a lot of research, and our population is getting older and older. My mom in February just passed away at 105 years old, so you might be listening and hearing me and seeing me for a long time to come, but who knows? None of us are getting out of this alive. But you won't be disappointed. So, Bobby, do you have on the screen who the speakers are? I just can't see them.
Yes, he does.
Yes.
Would you review them for me, please? And I'll talk a little bit, just kind of blow through them.
Sure. Paul Cella.
Paul Cella, if you've got any relationships with large organizations or charitable institutions or educational institutions, he is the master in the country of overlaying long-term disability on those and saving people 20 and 30%. And all you've got to do is make the introduction. Go ahead.
We've got Kevin Knebel.
Wow. If any of you have ever heard Kevin Knebel speak, you will be able to validate just how talented this man is with understanding all of the ins and outs, and more importantly, the depth of LinkedIn. We hired him. We paid him retail and hired him for 14 sessions. It was quite an amazing experience. Keep going.
Jason Kirshner.
Yeah, Jason is one of the really bright guys in our industry, and he's created a methodology that we've jointly used a number of times with regarding to rescuing assets out of qualified plans and turning it into an estate plan on an income tax deductible basis. Next.
David Mcknight.
Well, all of you on this call probably know David. He is the one who created the power of zero, and he's got a whole program not only with using life insurance and annuities as a means of increasing and guarantees people income, but doing so by being able to significantly reduce the amount of taxes that they have to pay. That's what the power of zero means. He'll be there. Bobby?
You already covered Dr. Rackner. Joe Strazzeri will be there.
Yep, Joe's an associate of with a separate office of Bruce and mine that I've known Joe for 15 years, I guess. And I think I introduced Bruce to him, I think.
Yep.
And Joe runs a couple of organizations that do training for attorneys and accountants and a few financial planners around the country. You'll find him completely different type personality, but very bright and very collaborative. Everybody that we have is collaborative in nature. They know that if they teach, that periodically they will get calls from our members, and that's kind of what this is about. It's each side helping each side, and you'll find it intriguing. Who else, Bobby?
Daniel Zeppelin.
Wow, Daniel's got a program for being able to actually legitimize senior settlement industry, which, to be honest with you, I have found to be one of the dirtier areas of our business because nobody knows under which shell the P is. And he's created a methodology of auction where the auction is open and above board, and everybody knows what the pricing are. They know when the dates are. They know what everybody's getting paid, and he's done some fabulous stuff for some of our members. Who else, babe?
Well, among several others that we'll have there, last but not least, we have Ed Slott.
That's true. Ed Slott's going to be speaking at our meeting also on our first day, and that was quite a coup. He normally doesn't speak to groups as small as ours. Not that we're that small, but we're not thousands of people. And Ed's probably the preeminent expert on IRAs and Roth conversions and what used to be beneficiary IRA trusts. Very entertaining, very bright, very knowledgeable. He'll be there as well. I think we've given him enough. So once again, if you're going to do it before the price goes up. Let's see, what's it go up to, Bobby? I know you said, but I forgot.
It is going up to, I believe, $750 for members, $950 for non-members. You can also bring significant others. They can attend meals and entertainment for $435. Breakfast, lunch are included all 3 days. Networking dinner on day 1. Heavy appetizers and an illusionist on day 2. A lot of other team building exercises that we'll be throwing into to kind of make it a little bit different and more fun for everybody when we're not actually sitting in the meeting sessions. So,
yeah. In any event, I'm glad everybody took the time today to listen to me ramble and Bruce be tangible and informative. Hopefully, we'll see you in 6 weeks, and have a good rest of your day. Take care. Thanks again, Bruce.
Thank you, Stuffy.
Everybody, bye-bye.